Welcome, everyone. You know that feeling, that little knot in your stomach when you think about money, about, well, what's next?
Mhm.
That sort of quiet anxiety about your financial future.
Yeah, I think a lot of people feel that.
It's definitely something a lot of us share. That nagging whisper that investing is crucial, maybe even essential, yet we freeze up. We hesitate.
Absolutely, it's a big hurdle.
It's not just a passing thought, either. For many, it seems like a deep-seated fear. So today, we're going to pull back the curtain on something pretty personal for a lot of folks.
Good idea. It needs talking about.
Now, this analysis isn't here to tell you exactly what to do with your money.
No, definitely not financial advice.
Right. It's more about unearthing why this pervasive fear of investing exists in the first place.
Mm.
We're aiming to understand it, maybe help navigate the complex, often intimidating world of personal finance.
Understanding the why is the first step, really.
We've gone pretty deep into our research, looking at studies, expert opinions, trying to extract the most important insights for you. The hope is you can maybe transform some of that apprehension into a bit more clarity.
Clarity is key.
So let me ask you directly, right now, as you're listening. Do you trust the U.S. market to invest?
That's a powerful question.
It really is. And it's one we're going to spend some significant time unpacking today. The core fear, losing money, and the hidden cost of inaction. Okay, so when we talk about putting our hard-earned money into the market, the biggest fear, the one that seems to scream the loudest, is just losing it, losing money.
That's the big one. The number one concern almost always.
It really is the dominant concern, isn't it? You see it echoing everywhere online.
Yeah.
Just scroll through social media, look at comments under financial content, and you'll see it constantly. I want to invest, but I'm scared.
It's raw, honest, captures that feeling perfectly.
And that sentiment isn't just, anecdotal chatter. Our research backs this up with some pretty compelling data. It shows just how real this fear is.
There are numbers behind it.
For instance, a 2024 World Economic Forum survey revealed something quite striking.
What did it find?
A significant chunk, 40% of individuals, made the explicit decision not to invest. And their primary reason.
Let me guess. Fear of losing money.
Exactly. That very fear. Think about that almost half the people surveyed chose to stay out of the market because of this one single overriding concern.
Wow. 40% is huge. That really highlights the scale of this apprehension.
It does. And it's easy to understand why this fear is so potent.
Absolutely.
We're constantly bombarded with news about potential market crashes, looming recessions, or just the daily ups and downs in stock prices.
Headlines can be terrifying.
Remember hearing about those wild swings, the dramatic drops, those headlines, and the immediate visible movements of the market. It makes it seem like a dangerous, unpredictable casino.
Yeah, like your money could just vanish overnight.
Yeah, exactly. It feels like a massive gamble, and nobody wants to gamble with their financial stability, their future.
Understandably so.
So that visceral fear, the one tied to volatility, it's incredibly powerful. It can make the very act of investing seem perilous, almost reckless.
It's a fear that can absolutely paralyze you, keep you stuck.
You're really stuck.
It's true, though, that fear is profoundly understandable, especially, like you said, when headlines sensationalize every single dip. But here's the fascinating part, and it's quite counterintuitive.
Okay.
While this fear feels protective, like you're shielding your savings, it can actually be financially detrimental in the long run.
How so? Detrimental.
Well, the cost of waiting, the cost of inaction, often quietly outweighs the very real fear of seeing, a temporary loss on paper.
So doing nothing has a cost too.
A significant one. Our research, including a major Charles Schwab study, concluded something really vital here.
Which was?
The costs of delaying your investment often outweigh any perceived benefits you might get from trying to perfectly time the market, waiting for the perfect moment.
Trying to buy the absolute bottom.
Exactly. Imagine two people. One waits, convinced they can time it perfectly, avoid the drops. The other just starts today putting money in consistently.
Okay.
The waiter often pays this hidden price, this tuition fee, if you will, that's far greater than any market volatility they hope to dodge.
A hidden fee. I like that analogy.
And it's not just about missing out on potential gains. It's about actively losing ground because of something called compound interest, or rather, the lack of it working for you.
Right, compounding. That's the snowball effect, where your returns start earning their own returns.
Precisely. It's the real engine of long-term wealth building. It's, frankly, kind of magical over long periods.
Okay.
When you delay investing, you're not just pausing growth, you're actively missing out on the exponential growth of your money over time.
Exponential's the key word there.
Absolutely. Let's say you invest just $100 a month for 30 years, earning an average, say, 8% annual return. You've put in $36,000 over that time.
Okay, $36,000 total contribution.
But because of compounding, that money could grow to over $136,000.
Wow, that's a huge difference.
It is. Now imagine delaying that start by just 10 years. You'd contribute less overall, sure, only $24,000, but your final balance would be dramatically smaller, maybe less than half of the $136K. Why?
Because you lost those crucial early years of compounding.
Exactly. Those first years are incredibly powerful. Every single day your money isn't invested, it's not earning anything. And that lost potential just compounds on itself, creating a significant opportunity cost.
Opportunity cost, the cost of the alternative you didn't choose.
Right. And Cindy Kumar, she's the CEO of Elevated Accounting. She put it really powerfully. I think this really nails it.
What did she say?
She said, avoiding investing feels like protection, but it's expensive. Inflation quietly eats away at savings, growth gets delayed, and you end up working harder just to maintain instead of using your money to build more freedom.
Working harder just to maintain. That hits home.
Doesn't it? And she doesn't pull any punches either. She adds, the fear is real, but so is the cost of staying frozen.
The cost of staying frozen, that's stark.
It is. Her point is critical. That feeling of safety you get from not investing, it's often an illusion. Because something else is constantly working against your cash.
You mentioned it just there, inflation.
Bingo. Inflation. Let's dig into that a bit more, because it's the silent, often overlooked erosion of your wealth.
Okay, how does that work exactly?
Well, while your cash might feel perfectly safe sitting there in a savings account, untouched by market ups and downs.
Yeah, seems safe, the number doesn't go down.
Right. But inflation is relentlessly reducing its buying power. Think of it like this. That crisp $100 bill in your wallet today, it might only buy, say, $70 bought 10 years ago.
Oof. Right, things get more expensive.
And in another 10 years, it could buy even less. What costs you $1 today could easily cost $1.30, maybe more, in just a decade, thanks to average inflation rates.
So even though the dollar amount stays the same, what it can actually buy shrinks.
Precisely. Your safe cash, the money you're holding onto so tightly, is slowly, quietly shrinking in real value. It buys less and less over time. And you never see a minus sign in your bank account statement for it.
It's invisible, almost.
Completely invisible loss of value. And this is the crucial contrast with the stock market's historical ability to grow money at a rate that, on average, over long periods, outpaces inflation.
So the market helps preserve or even increase your actual buying power.
Exactly. It preserves and potentially enhances it over the long term. So while cash feels secure day to day, it's actually diminishing in purchasing power, which is a form of financial loss in itself, just one that's not as immediately visible or scary as a stock market dip.
Okay, that's a really important point, the hidden cost of inaction, especially with inflation.
Yeah.
It definitely reframes what safe actually means.
It has to. Safety isn't just about the numbers staying the same.
But if fear of loss, coupled with this inflation issue, is one leg of the anxiety stool, what are the other pillars holding people back? Beyond just losing money directly, there seem to be other anxieties that keep people frozen.
Oh, absolutely. It's rarely just one thing. 2, deconstructing other key fears, beyond just monetary loss.
One of the biggest barriers our research pointed to is simply the fear of the unknown. It often shows up as this feeling of, well, just not knowing enough, a lack of knowledge.
Yes, the complexity barrier is huge.
For so many people, investing feels incredibly complicated, intimidating even. You start looking into it and you hear all this jargon.
Right. Dividends, index funds.
Exactly. Dividends.
Correct.
Okay, maybe you figure out that's your share of company profits. Index funds, a basket of stocks, sound safer maybe. But then you hit things like PE ratios, price to earnings. What does that even mean? Is it good? Bad? It feels like a foreign language.
It absolutely can feel like that. A secret code.
And it can be incredibly overwhelming for someone just trying to grasp the basics. So this lack of clear understanding, it naturally leads to this belief, right, that investing is only for experts.
Or rich people.
Or rich people. People who somehow just get it, especially if you weren't explicitly taught about it growing up or in school.
It creates this perception of an exclusive club.
Totally. An exclusive club you can't possibly join unless you have a finance degree or something. And that feeling alone is enough to just stop countless potential investors in their tracks.
That perceived complexity is definitely a powerful psychological barrier, no doubt about it. But here's the truth, the one that often gets lost in all that noise and jargon.
Okay?
You absolutely do not need to be a financial genius to start investing and to grow your wealth over time.
Really? Because it sure feels like you do sometimes.
I know it feels that way, but the beauty is that simple, straightforward strategies have successfully helped millions, literally millions, of ordinary people build significant wealth.
Without picking individual stocks or analyzing PE ratios.
Exactly. Without needing to pick single stocks, without needing to pore over complex financial statements, or even trying to time the market perfectly. We're talking about strategies that are accessible to everyone.
So not just for the finance pros.
Not at all. Think of it like driving a car. You don't need to understand every single component of the internal combustion engine to get where you're going safely.
Uh-huh. Good point. I definitely don't.
Right. You just need to know how to operate the car safely and efficiently. Investing can be similar. The idea that it's only for the elite is really a misconception born from that initial feeling of being overwhelmed. The reality is far more inclusive.
Okay, that's encouraging. But when something feels that complicated, our natural instinct is to retreat, isn't it? To
Yeah.
go back to what we do understand, what feels solid.
It makes sense. Seek comfort.
Yeah. So it's no wonder many people then look at their, say, savings account or maybe a certificate of deposit, a CD, and think, why risk it?
Mm.
Why risk everything when I can just keep my money right here?
The perceived safety of cash.
There's such a powerful psychological comfort in seeing that balance, knowing it's not going to suddenly drop by 10% tomorrow because of some news event.
It feels secure because it can't, quote unquote, disappear.
Exactly. That stability, that visible presence of your money, it provides a sense of control, a sense of safety that market investments, with their ups and downs, just don't offer on the surface.
It's a very understandable human desire for certainty, for that immediate, tangible security. We crave that.
We really do.
It absolutely is understandable. And that's where we circle right back to the catch we talked about earlier.
Inflation again.
Inflation again. While cash in a savings account gives you that immediate feeling of security, it's often an illusion of safety when you look at it through the lens of long-term buying power.
The slow leak.
A slow leak in the tire, exactly. You don't notice it day to day, but over time, your ability to actually use that money effectively diminishes significantly.
So the comfort today costs you later.
What you gain in emotional comfort today, you often lose in real purchasing power over the years. The stock market, on the other hand, for all its short-term bumps,
And there are bumps.
there are definitely bumps, but historically, it offers the potential for growth that can counteract and often significantly outpace inflation.
So cash shrinks in value, while the market offers a chance for growth.
That's the fundamental trade-off. While your cash feels safe, it's essentially shrinking in real terms, whereas the market, despite its risks, provides a pathway for your money to actually grow and maintain or even increase its value over the long haul.
It's the difference between just preserving your current buying power or maybe even watching it erode versus potentially growing it.
Precisely. It's about choosing which risk you're more comfortable with. The visible risk of market fluctuation or the invisible risk of inflation eating away at your savings.
That distinction between nominal safety, the number staying the same, and real value, what it can actually buy, is so critical.
It really is.
But okay, let's tackle another really common reason people hesitate. Another fallacy we see all the time in our research. It's the idea that, oh, the market is way too high right now, it's overvalued, I'll just wait for it to come down.
Ah, yes, the market timing temptation. Very common.
It often comes from a good place, right? A desire to be smart, to buy low. People look at stock prices, maybe they've been going up for a while,
They see a big run-up.
and they assume a crash must be just around the corner. Or they feel there's just too much optimism, prices are inflated, so they decide, I'll wait. I'll wait for that perfect moment, that big dip, to buy in at a discount.
Sounds logical on the surface.
It sounds incredibly savvy, like a calculated strategic move.
Hmm.
But our research shows why this seemingly logical approach is actually deeply problematic in practice.
Problematic is putting it mildly sometimes. It can be one of the costliest mistakes for average investors.
Costly how?
You're absolutely right. It sounds intuitive to buy low, but the reality, frankly, is harsh. And historical data confirms it again and again.
Which is
No one, and I mean no one, not even the most brilliant professional investors with decades of experience and supercomputers running complex models, No one can perfectly, consistently time the market.
It's just not possible.
It's essentially a futile exercise. We have seen countless examples, real people sit on the sidelines with their cash, waiting for that perfect downturn,
Waiting.
only for the market to just keep climbing. They might sit out for months, sometimes even years, missing out on significant gains while they wait.
And then maybe they get frustrated and jump in higher than where they started waiting.
That happens all the time. By the time they finally feel safe enough to get in, prices are often even higher than when they first decided to wait. It's like trying to catch smoke with your hands. You think you've got it figured out, but it just slips away.
So waiting often backfires.
It very often backfires. Our research really reinforces this powerful lesson, almost a mantra in investing. The best time to invest is when you have the money and can stay invested for the long term.
Time in the market, not timing the market.
That's the classic phrase, and it holds true. This principle directly contradicts that market timing fallacy. And here's another critical point that fear often prevents people from acting on.
Okay.
Historically, some of the very best market gains, the biggest upswings, happen right after significant downturn.
Probably right after the scary part.
Exactly. When the market is down, fear is usually at its peak. Most investors are panicked, pulling out, or avoiding putting any more money in.
Understandable reaction.
Totally understandable. But for those who have a long-term perspective and maybe a bit of courage based on that perspective, these moments are actually incredible opportunities.
Opportunities to buy low, essentially.
You buy quality assets at a discount, setting themselves up for potentially much stronger returns during the eventual recovery. So waiting usually means you miss both the gradual, everyday growth and often the most opportune moments for discounted entry.
Wow. So waiting is like a double whammy against you.
It really can be. It's a tough truth to accept, especially when fear is high, but it's absolutely vital for long-term investing success.
That is a tough pill to swallow, especially when, like you said, it feels like you're being strategic by waiting. But, it raises a deeper point, doesn't it?
What's that?
If timing the market is basically futile and just buying and holding seems too simple, maybe, it almost feels like the game itself might be rigged.
The trust issue.
Yeah. Which brings us to maybe an even deeper layer of apprehension. It goes beyond market timing, or even the direct fear of loss. It's a fundamental lack of trust in the system itself.
That's a big one too, very real for many people.
There's this pervasive belief, you hear a lot, that the market is rigged, that it's designed to favor the big players, the hedge funds, the large institutions, the Wall Street insiders.
The smart money.
Right. And you hear stories, right? Insider trading scandals, accusations of market manipulation.
And big crises stick in people's minds.
Exactly. You remember major events that really shook public confidence, like the 2008 financial crisis, or maybe the dot-com bubble bursting back in 2000?
Those leave scars, financial scars.
They really do. And these events and the narratives around them, they solidify that feeling for many that the system just isn't built for the average person, that the game is inherently stacked against them.
Like you're playing poker, but you don't know all the rules, and maybe someone else can see your cards.
Perfect analogy. And that distrust makes investing feel like you're just handing your money over to forces you can't possibly understand or control. Like you're destined to lose in a game where the rules are always changing and always seem to favor the powerful.
It's a significant psychological barrier, perhaps the deepest one, as you said, because it undermines the very foundation of belief in the whole system. If you don't trust the game, why would you play?
Exactly. Why play at all?
It's an absolutely valid concern. You can't dismiss it, given past events and just the sheer complexity of the global financial world. It's true that risks exist, and yes, unfortunately, bad actors exist in pretty much any large system.
Okay, so the concern is valid, but...
But what's often overlooked, or maybe undercommunicated, is the reality of regulation and accessibility in today's market.
Regulation, like the government stepping in.
Yes. While no system is perfect, the market, especially in the U.S., is highly regulated. You have bodies like the Securities and Exchange Commission, the SEC. Their entire job is to create and enforce rules designed to protect investors and maintain fairness.
How do they do that?
Through things like requiring companies to disclose huge amounts of financial information, mandating independent audits, rules against insider trading. These measures are specifically there to prevent the kind of widespread, blatant manipulation that people fear. It's not foolproof, but it's a substantial framework.
Okay, so there are protections in place.
There are significant protections. And perhaps more importantly, beyond regulation, The market has a proven long-term track record of growing wealth for investors who stick with it.
Despite the crises and the bad actors.
Despite the crises, despite the volatility, despite the bad actors, our research consistently shows that ordinary people, regular folks, who consistently invest in diversified ways, typically through things like index funds or mutual funds.
We'll get more into those later.
Right. But people who do that historically do very well over time. And this happens regardless of the short-term noise, regardless of what big institutional investors are doing day to day, or even specific scandals that might make headlines.
How does diversification help against a system that feels potentially rigged?
That's a great question. It helps because when you're diversified, you own a tiny slice of many strong companies, often hundreds or even thousands.
So you're not reliant on just one.
Exactly. You are participating in the overall growth of the economy, which, despite bumps, has historically trended upward over decades. You're not betting on individual players or trying to outsmart the system. You're essentially betting on the system's long-term growth.
So even if one company or one bad actor messes up,
Your overall portfolio is cushioned by the performance of hundreds of others. The key, as our research really emphasizes, is to shift your focus. Move away from trying to predict daily fluctuations or fixating on the perceived actions of Wall Street insiders.
and focus on
Focus on long-term ownership of good businesses, often through these diversified funds. The system is fundamentally built for economic growth over time, driven by innovation and productivity. And regular people can absolutely participate in and benefit from that long-term growth. 3. Strategies to conquer anxiety and build confidence.
Okay, those insights are incredibly valuable. Hearing about regulation and the power of diversification really does offer a much-needed counter-narrative to that feeling of distrust.
Hopefully it provides some perspective.
It does. But, knowing why we're scared is only half the battle, right?
Yeah.
The next crucial step is figuring out how to actually move forward, how to conquer that anxiety and start building some confidence.
Actionable steps. That's what people need.
Exactly. So let's shift our conversation now to those actionable steps. Let's focus on some approachable investment options that hopefully don't feel quite so overwhelming.
Good. Let's make it practical.
Our research has highlighted a few key approaches, starting with what some experts we looked at refer to as investment options that won't keep you up at night.
Haha. I like the sound of that. Sleep is important.
Definitely. The first, and maybe the most foundational recommendation we saw repeatedly, comes from Asher Ragovi. He's the Chief Investment Officer at Magnafina.
Okay, what does he suggest?
He strongly recommends starting with index funds.
Ah, index funds. We mentioned those briefly.
Right. He explains that these funds essentially hold hundreds of stocks.
Right.
That means when you buy into one, you're buying tiny pieces of many different companies all at once, not just betting on one or two.
Instant diversification.
Exactly. And this is a critical point, he says, because it allows investors to, quote, earn a typical market return without worrying about a catastrophic loss from a single bad company.
Makes sense. If one stock in the index goes to zero, it barely impacts the whole fund.
Precisely. Imagine, instead of putting all your chips on one unpredictable horse in a race, you're betting on the entire stable, or maybe even just the average performance of all the horses.
Reduces the stress level considerably.
It dramatically reduces risk and, by extension, anxiety. Your financial well-being isn't tied to the fate of just one company's stock price. It's about getting broad market exposure, smoothing out those individual bumps along the road.
It's a great starting point for many.
And Robert R. Johnson, he's a professor of finance at Creighton University, he agrees wholeheartedly. He emphasizes that a diversified stock portfolio is really a key way to build wealth over time.
Another vote for diversification.
But he offers this fascinating, almost counterintuitive statement that really made me pause.
Oh, what's that?
He says, counterintuitively, the biggest mistake many people make in investing is not taking enough risk.
Not taking enough risk. That sounds backwards given our topic.
Right. But he clarifies. He's not talking about reckless gambling,
Yeah.
Throwing caution to the wind on some speculative bet.
Okay, good.
He explains it with this old Wall Street adage that really makes you think. It's the idea that you can sleep well or eat well.
Sleep well or eat well? Explain.
He clarifies, you will sleep well if you commit funds to low-risk investments, like money market funds or treasury bills.
Yeah.
Basically, things very close to cash, very safe in the short term.
Okay, the sleep well option sounds nice.
It does. But, he continues, your investments will not grow substantially and may even have trouble keeping pace with inflation. Sound familiar?
There's the catch again. You sleep well, but your money isn't really growing. It might even be shrinking in real terms.
Exactly. Then he says, you will eat well by consistently investing in stocks, meaning that's where the real long-term growth comes from, the growth that outpaces inflation and builds actual wealth.
So the eat well option requires taking on that market risk, but offers much greater potential reward over time.
Precisely. It really encapsulates the core dilemma, doesn't it? That perceived safety of low-risk options today often means you're just treading water financially, maybe even slowly sinking in terms of buying power, while the consistent long-term growth potential of stocks is what actually builds significant wealth and future prosperity, future ability to eat well.
It forces you to ask, are you prioritizing immediate comfort over long-term well-being? Sleep now or eat later?
It's a powerful framing. Professor Johnson also recommends mutual funds and ETFs, exchange-traded funds, calling them wonderful strategies for just about any investor.
More accessible options.
Yes, and he notes this is particularly true for people starting with limited capital, maybe just a few hundred or $1,000, who need that adequate diversification, but obviously can't afford to buy shares in hundreds of individual stocks themselves.
Right, buying 500 different stocks would cost a fortune.
Exactly. But mutual funds and ETFs are these professionally managed baskets of investments. They provide instant diversification. Instead of buying 500 different stocks, you buy one share of an ETF that holds those 500 stocks.
One purchase, instant diversification. Much simpler.
Much simpler. It gives you exposure to all those companies or sectors or even the whole market, depending on the fund. This makes them incredibly accessible entry points for new investors who want to mitigate that single stock risk we discussed and participate in market growth without needing to become a stock-picking guru.
Those are definitely excellent, accessible starting points. And the key theme, again, is diversification. It directly addresses that core fear of losing everything if one investment goes bad.
Right.
But beyond what to invest in index funds, ETFs, there's still the question of how to actually start, especially if you're facing anxiety about putting a larger sum of money, maybe from savings or an inheritance, into the market all at once. That can feel terrifying.
Oh yeah, the plunge feels risky.
Exactly. Our research provides some very practical advice here for building confidence through a more gradual approach.
Okay, gradual sounds less scary.
Stephen Shupp, he's a finance professor at Wake Forest University, offers a very calming recommendation that tackles this exact anxiety head on.
What does he suggest?
He says, essentially, if you're nervous, don't try to deploy everything at once. Don't feel pressured to invest that whole lump sum today.
Okay, so break it up.
Exactly. Instead, he suggests spreading your investments out over, say, 12 months, or maybe even 24 months if it's a really large sum or you're particularly anxious.
Invest a smaller piece each month.
Right. He calls this a gradual approach, and it serves a really important dual purpose. First, psychologically, it helps build muscle memory.
Muscle memory for investing.
Yeah, it makes the act of investing a regular, less daunting habit rather than a huge one-off terrifying event. And second, financially, he says it makes it easier to stay the course during market fluctuations.
Because you're easing into it.
You're easing in. You haven't put everything on the line at potentially the worst possible moment. For example, if you have $12,000 saved up to invest instead of putting it all in today.
You could invest $1,000 each month for a year.
Precisely. Each individual investment feels smaller, less risky, more manageable. It lowers the emotional stakes each time.
That makes a lot of sense psychologically.
And this leads us directly into one of the most powerful and widely recommended strategies for nearly all investors, but especially new ones. SHIP also champions this. It's called dollar cost averaging, DCA for short.
Dollar cost averaging. Okay, how does that work?
It's not just a strategy, it's really a discipline. It's designed to remove emotion from your investment process almost entirely.
Removing emotion sounds good when fear is high.
It's crucial. DCA means committing to invest a fixed dollar amount on a set schedule, like, say, $100 on the first Monday of every single month, no matter what the market is doing.
No matter what. Even if the news is terrible.
That's the key phrase. No matter what the market is doing. SHIP emphasizes this point strongly. Even if it's crashing that day, you stick to the plan, no excuses.
Wow, that takes discipline.
It does take discipline. But think about what it achieves. When the market is high, your fixed $100 buys fewer shares of that index fund or ETF.
Okay, because prices are up.
Right. But when the market is low, when prices have dropped, that same $100 buys more shares. Ah, so you automatically buy more when things are on sale.
Exactly. You're automatically buying more shares when prices are low and fewer shares when prices are high, without ever having to guess or predict market movements. This systematic approach takes emotion out of the equation. It protects you from that paralysis of trying to time the market, or worse, panic selling at the bottom.
Because you just follow the schedule.
You just follow the schedule. And this strategy also powerfully reinforces that principle we keep coming back to. Time in the market matters more than timing the market.
Because you're always in, consistently.
You're consistently investing that fixed amount. You ride out the market's inevitable ups and downs. Over time, this tends to lead to more balanced growth, and crucially for our discussion today, a significant reduction in fear. Why? Because you're following a proven logical plan, not reacting emotionally to scary headlines?
Having a plan reduces anxiety.
Immensely. And Asher Ragovi, the CIO we mentioned earlier, adds another important point about accessibility here.
What's that? He points out that now that many brokerages offer $0 commissions and fractional shares, small investors can build professional-grade portfolios without significant costs.
Zero commissions helps. What are fractional shares?
Fractional shares mean you don't have to buy a full, potentially expensive share of a stock or ETF. If a share costs $500, you can just invest, say, $50 and own zero 0.1 shares.
Oh, wow. So you can start with really small amounts.
Exactly. You don't need thousands of dollars to get started with DCA. You can begin with small, regular contributions, $50 a month, $25 a month, whatever fits your budget, and still build a diversified portfolio over time. It makes investing truly accessible to almost anyone.
That really lowers the barrier to entry.
Hugely. And okay, here's a little pro tip that came up in our research, something that builds on this DCA idea.
Ooh, a pro tip. Let's hear it.
During those market dips or corrections, which, remember, are inevitable, a natural part of the cycle, consider doubling down on your investments if you have the means.
Doubling down, so investing more when things look scary.
Exactly. While your fear instinct might scream, pull back, protect your cash, adding a bit extra to your regular DCA contribution during those downturns allows you to buy even more shares at those deeper discounts.
Leaning into the sale even more.
Leaning into the sale. This can potentially set you up for even stronger returns when the market eventually recovers, which historically it always has. It's about turning a moment of widespread fear into a personal opportunity for potentially greater long-term growth.
That requires overcoming fear, but it sounds strategically smart if you have a long time horizon.
It's definitely a strategic move for those who understand the long-term game and have the confidence, built perhaps through starting small and using DCA, to act when others are fearful. 4. The long-term perspective and building generational wealth.
Those strategies, starting with index funds, using DCA, maybe even doubling down on dips, they really provide a clear, practical path for overcoming that initial anxiety and building confidence step by step.
The goal is to make it manageable, less intimidating.
Absolutely. But as we start to wrap up this analysis, I want to kind of zoom out a bit, guide our listener towards an even broader vision of what financial security can look like. Let's shift the focus from overcoming those short-term fears to embracing truly long-term goals.
Thinking bigger picture.
Exactly. Because once you start to conquer those initial anxieties about investing, you open the door to thinking beyond just your own immediate future. You can start thinking about, well, legacy.
Looking further down the road.
This brings us to the concept of investing for generational wealth. Because true financial security, the kind that lasts, and the accumulation of really significant wealth over a lifetime, it isn't built by chasing quick wins.
No quick fixes in investing.
And it's not built by perfectly timing the market in the short term, as we've discussed. It's fundamentally built by thinking 10, 20, even 30 years ahead or more.
A marathon, not a sprint.
Definitely a marathon. It's about truly understanding and harnessing the power of compounding growth, that magic of your money earning returns, and then those returns earning their own returns, decade after decade. That is the true, time-tested path to building substantial wealth.
Slow and steady really does win the race here.
It really does. Imagine that simple $100 a month contribution we talked about earlier. We saw how it could grow over 30 years. But what if you started earlier? Stayed invested for 40 years instead of 30.
Even more time for compounding to work its magic?
Exactly. With the same average 8% return, that same $100 a month invested for 40 years could potentially grow to well over $300,000, maybe even closer to $350,000 from just $48,000 in total contributions. Self-correction. Initial calculation was likely off, reevaluating based on standard compound interest calculators. A 100-month contribution at 8% over 40 years is closer to 350K. Let's use that.
Wow, the extra decade makes a massive difference. That really shows the power of time.
It's incredible, isn't it? That's the power of time and compounding working together. And our research highlights practical ways to participate in this long-term growth. We mentioned investing in those well-known companies
Yeah.
that have stood the test of time.
Like the big tech names people recognize.
Yeah, you hear about groups like the so-called Magnificent Seven companies, like Apple, Microsoft, Amazon, Alphabet, Google, Meta, Facebook, Tesla, NVIDIA. Or, perhaps more simply for most people, investing in those broad, diversified funds we discussed, like VOO, which tracks the S&P 500, VTI, the total U.S. stock market, or maybe SCHD, a popular dividend growth ETF.
So owning a piece of the big players or the whole market?
Right. These aren't just abstract stock tickers. They represent robust investment vehicles that give you ownership in a wide array of businesses. Many are pillars of the modern economy, likely to be around, innovating, and growing for decades to come.
You're investing in ongoing economic progress.
When you invest in these types of assets for the long term, you're not just buying a stock certificate. You're buying a piece of that ongoing progress, a stake in the future of innovation and economic growth.
It shifts the mindset from short-term gambling to long-term ownership.
Beautifully put. And crucially, this isn't just about securing your own financial future, your own retirement. It connects to a much larger legacy.
Thinking beyond yourself.
Yes. When you consistently invest over the very long term, you're not merely building security for yourself. You are potentially creating a financial legacy for your children, maybe your grandchildren, maybe even generations beyond that.
Building generational wealth.
Exactly. You're setting up a foundation that could provide future generations with opportunities that might have been out of reach otherwise.
Like helping with education costs or a down payment on a house.
Precisely. Or maybe just giving them the freedom to pursue their passions without being constantly haunted by the same financial anxieties that perhaps we or our parents faced. It's like, planting a tree whose shade you might never personally sit under.
But that will provide shelter and sustenance for those who come after you.
Exactly. It's a powerful, long-term perspective shift. Final thoughts and moving forward.
That long-term vision, thinking about legacy, it really is key to overcoming the short-term noise and fear. So to kind of bring all our threads together here, what our analysis consistently shows is this. Avoiding the stock market because of fear, because of distrust, because you're endlessly waiting for that perfect moment that never comes.
Yeah, all those reasons we discussed.
It might feel like the safest choice day to day. It might let you sleep a bit better tonight. But in reality, it is very likely one of the costliest decisions you can make for your long-term financial future.
The cost of inaction again.
The cost of inaction. The market, for all its volatility and bumps, fundamentally rewards certain things over the long haul. It rewards patience. It rewards consistency. And above all, it rewards time.
Patience, consistency, time.
It rewards those who are disciplined, who can develop a plan, stick to it, and see beyond the immediate, often scary, headlines.
So the core message then is?
The core message we really want to reinforce, based on everything we've looked at, is simple. Don't wait. If you're able, don't wait. The single biggest regret many seasoned investors express is simply not starting sooner.
Getting those early years of compounding working for them.
Exactly. Start small if you need to. Fractional shares and zero commissions make that easier than ever. Think long-term focus on decades, not days. And just take that first step toward building real, lasting wealth.
That first step is often the hardest.
It always is. But every journey begins with that single step.
Yeah.
And in investing, consistency, just showing up month after month with your contribution, no matter how small, truly is your greatest asset. It's about building a powerful habit that compounds both your money and, just as importantly, your confidence over time.
Building confidence alongside wealth.
Absolutely. One final point, though, and it's an important one to mention.
Okay.
While investing is, as we've discussed, arguably a necessary part of planning for a financially stable future in the face of inflation, if the anxiety associated with it is truly profound.
Like really debilitating.
Yeah. If it's genuinely keeping you frozen, preventing you from making any smart financial decisions at all, or if it's causing significant distress in your daily life, spilling over into other areas.
Then maybe it's more than just needing financial education.
It might be. In those cases, it may be time to consider consulting with a financial therapist or perhaps another qualified mental health professional. Sometimes these fears are tangled up with deeper issues than just financial literacy.
And professional support can help untangle that.
It really can. It can be incredibly beneficial in identifying and overcoming those deeper psychological barriers that might be keeping you stuck, allowing you to then approach the practical side of investing with more clarity and less fear.
That's a really powerful and compassionate point, recognizing the very real emotional weight these decisions carry.
It's crucial. Money is emotional.
It absolutely is. So as we conclude this analysis today, I want to leave you, our listener, with maybe one final provocative thought, something to consider long after this conversation ends.
Okay, leave us with something to chew on.
Understanding and confronting these pervasive feels about investing. It isn't actually just about accumulating more money or figuring out financial markets, is it?
What's it really about then?
It's actually about something far more fundamental. It's about reclaiming a sense of agency, a sense of control over your own future. It's about having the knowledge and building the confidence to make informed choices for yourself in a world that often feels incredibly uncertain.
Empowering yourself.
Exactly. It's about empowering yourself to consciously build the future you truly want, hopefully freer from that paralyzing financial fear we started with.
A worthy goal indeed.
Thank you so much for joining us for this analysis today. We hope exploring these fears has been helpful.
Hope it sparks some thought, maybe some action.
If you found these insights valuable and you want more discussions like this, talks that aim to help you gain financial knowledge quickly and thoroughly, please make sure you subscribe wherever you're listening.
We'll keep exploring these important topics.
Yes, subscribe to get more investing talks and actionable analysis that can hopefully empower your financial journey. Thanks for listening.